Okay, in this video we wanted to cover some of the very simple high-level differences between a C corporation and an S corporation. So to start with the basics, what is a corporation generally, right? So a corporation, it's a legal entity formed under state law, so it's in Delaware, Florida, Wyoming, Nevada, whatever state you're in. And the corporate entity is a separate and distinct entity from its owners, so the shareholders in this case. And that's really important because under state law, a corporate entity is treated just like any other kind of legal person, right? It can enter into contracts, it could borrow money, it could sue people or companies, it can be sued itself, it can hire employees, it can own assets or other types of property. So it's just like an individual in a lot of contexts. Now, when you have a corporate entity formed under state law, by default, it's going to be treated as a C Corp for federal and state tax purposes. Okay, so that's very important. So whenever you set up a corporation, you can presume that as long as it's a for-profit stock corporation, it's going to be treated as a C Corp for federal tax purposes. Okay, so what are the attributes of a C corporation? Well, C corporation entities have that double taxation element, right? So the corporate entity itself is subject to federal and state taxes directly, and then any after-tax profits can be either reinvested in the company so they can retain that cash, or they can distribute the cash as a dividend distribution to the shareholders. And then once the shareholders receive that dividend income, they'll likely have to pay income taxes on it, on their personal or business tax returns. So C corporations need to file a Form 1120 tax return each year. They report their net profits or losses. In cases where they have profits, they might have to pay corporate income taxes. And then again, any dividends distributed to shareholders might be subject to tax at the shareholder level. So that's the double taxation element. Now, dividends distributed to shareholders that are U.S. persons, the corporate entity has to report that on a Form 1099 div. So that's the third-party reporting that gets sent to the IRS, and a copy goes to the U.S. individual that received the dividend. If the dividend is paid to a foreign person, so if a non-U.S. owner owns shares in a U.S. company, the dividend payments still have to be reported, but they're not reported on a 1099, they're reported on a Form 1042-S. Okay, so 1042S's are reported for foreign persons. Now, what's unique about foreign persons is when they receive a dividend, likely they're subject to the withholding tax at source. So U.S. persons just get the full amount of the dividend, they report it on their tax return, they pay tax that way. A foreign person might not actually have to file a U.S. return. And so in order to make sure that the federal government gets its money, they require withholding taxes at source. Now, the standard rate is 30%, excuse me, but it can be reduced under a tax treaty. So I have an example here, a very simple one. We have a Delaware corporation. It's owned 100% by James, so he's a UK citizen and tax resident. Let's say James lives in London. If the Delaware corporation distributes a dividend of $10,000 to James, the standard rate is 30% withholding tax. That's what gets paid to the IRS. So the company would have to withhold $3,000, pay that to the IRS, and James only gets $7,000. Okay, but under the U.S.-UK tax treaty, because James is a UK tax resident, the withholding rates can be reduced. Right. So under the treaty, in Article 10 of the treaty, in this context, the withholding rate would be reduced to 15%. So instead of paying 30%, James only takes a 15% hit. Okay, so that covers it for the C Corps. Now let's talk about the S corporation structure. So very, very important here, this first line item I'm highlighting now. An S corporation is not a legal type of entity. Okay, very, very important. I see this terminology thrown around incorrectly a lot. You cannot, quote, form an S corp under state law. If you went to a state registrar, let's say you went to Delaware, and you asked them to open a S corporation for you, they would give you a very blank stare because there's just no such thing. S corporation is a federal tax election. So in order to make that tax election, you first have to form either a corporate entity, or you can form an LLC, you can form a PA, which is a professional association, a PC, which is a professional corp. You can form a PLLC, that's a professional limited liability company. You've got to form some type of domestic eligible entity, and then file the S corporation election afterwards. Okay, and that's done via Form 2553. Now, what are some of the attributes of an S corp? Well, S corporations aren't subject to tax directly on the profits, unlike a C corp. So any profits in an S corp are passed through to the individual shareholders, and they report the profits on their personal tax returns. Okay, and this information is reported on a Schedule K-1. So when S corp files a Form 1120S, and each owner, each shareholder gets a Schedule K-1, which shows their allocation of the income, expenses, credits, distributions, and everything like that. And so all of those items are ultimately reported on the shareholders Form 1040. Now, some of the unique limitations with S corps. An S corp can only have 100 or less shareholders, right? So it's only in closely held companies where you'll see this S election. And they have to be U.S. individuals. This is also a little unique nuance. You can't have an S corp that has an owner that's, let's say, a partnership. So if you have an S corp that has if you have a corporation that's got a shareholder that's, let's say, a Delaware LLC that's a partnership, you can't make that S election because you have to have a less than 100 or less shareholders, and they've all got to be U.S. persons, U.S. individuals. And then the last one there, only one class of stock. So what does that mean? Well, one class of stock means that everything is allocated in proportion to each shareholder's ownership interest in the company. So the company can only have, let's say, Class A common stock. It can't have Class B, Class C, Class D, and so on. So it can only have Class A common stock, and everything is allocated in proportion to what each shareholder owns in the company. So you can't have any strange special allocations, which are generally allowed in a partnership context. So for a partnership, filing a Form 1065, you can allocate things kind of almost however much you want. You can have income items allocated to partners that kind of is in conflict with what their capital percentage ownership is. So that's one unique little limitation with the S corp structure. Okay, so that covers it for some of these high-level differences. If you have any questions, please leave me a comment below. Happy to answer those, and I look forward to seeing you again soon. Thank you.